traders, welcome to the Trade Desk Global video and charting review. This is for the 1st of June 2011, looking at the dollar index and currencies in this charting review of the markets as we go into non-farm payrolls on Friday. We do ask that you pause the video, read the disclaimer and accept that before proceeding. The news wires have been very busy today on Wednesday in regard to ADP employment numbers and the ISM, Institute of Supply Management numbers. And this is where we get a real test of the correlation between the US dollar and equities when US-based economics are very weak. Tends to take the risk out of the equity market. Equities get sold, and in general, rather than just going to cash, there's a move to US Treasuries, bonds, the safety of bonds, and the US Treasury market is the largest bond market that a move could be made to. So as you get negative headlines, that reduces the value of equities because of forward commitment, forward sentiment to the fact that negative analysis on economics could lead to potentially weaker outlooks for companies. Equities get liquidated, move to bonds which are US dollar based. The US economics being bad tend to strengthen the US dollar, but we're going to see the fact that it's a little bit disjointed today. In the Trade Desk technical review, we're going to be looking at the impact of the move out of stocks and into the dollar, and we're going to be looking at a near-term chart. Tomorrow's video will take the individual currencies and really strip each one down ahead of the non-farm payroll. We've got the dollar index on top, we've got the S&P below, both of them the futures contracts, and we can see where the S&P in the previous two sessions were just kind of angling up. The risk was getting bought. S&P bounced off the 50-day simple moving average, which is the green line here at 1327, and we saw a real strange period of trade on the close of business on Tuesday. Understanding that Monday was a very flat day, bank holiday in the US and in the UK, but it was an open market for the rest of the world. We got a short signal on the S&P coming into about 3 o'clock on Tuesday. There was a short signal formed on S&P futures. It was into a long trend, so we were waiting for some final confirmation, and that was bouncing around the 20-day simple moving average as well. But within 30 minutes of the close, we got this gap. The markets created a gap in the last 30 minutes of trade on Tuesday, which was a month end push, try and close at that 1345 high. We sent a note out to clients not to take too much notice of it. Certainly do not buy into it because there was something very disjointed about the global markets. And also we had ADP, the US employment on the private side of the employment docket, and also we had the ISM manufacturing coming out on Wednesday, both of which have a strong history of creating price movement. So we could see that as the US dollar was going lower, in line with S&P markets going higher, we had a market that had equilibrium. Then we had at 10 o'clock the ISM non-manufacturing numbers came out, and they were very weak. And those numbers at 10 added to the ADP numbers earlier in the session created a very strong move lower on the S&P. As we can see, the dollar took a little while to actually pick up on that move. The dollar index wasn't bought to the same degree that equities were initially sold. We saw euro holding higher. Euro makes up 60% of the dollar index. We saw the pound still holding. We saw the Australian dollar and the Canadian dollar holding. We saw the Swiss franc and the Japanese yen actually getting bought against the dollar because they're the interest rate connected markets, because treasury yields tumbled heavily and treasury note values went up. But there was a real delayed action here, and this is very important to what we're going to see going into non-farm payrolls on Friday. The global market doesn't want to buy dollars for the long haul. It's abundantly clear with weak economic analysis coming out of the US Doesn't stop the dollar from getting bought. It can't. Because as you move out of equities, you do need to move into bonds, and the most liquid is the treasury market. There's a repatriation also of US dollars. Not that people want to get long the US dollar because of the economic outlook, though, but there's a lag factor here. Now, the dollar index is running into 75.20, 50-day moving average, which we would expect to see dollar strength in the near term going into the non-farm payroll if global equity indices, the Japanese Nikkei and the German DAX, get sold ahead of the Wall Street Open on Thursday. We do believe that if we can get a close below 13.15 this week on the S&P, and we don't think that this is going to be one elevator ride lower on the S&P, but if we can close below 13.15, we do believe that 12.95 and 12.75 could be seen during the course of June. That then leaves the dollar index with a little bit of a struggle. 75.50 is going to be a bit of a test. That would get the equivalent euro valuation down to around 143. We'll look at that quickly in a moment. But then above that is 76.50, which equates to 142 on euro dollar. If the S&P can hold around this 13.15 and not move higher, the dollar index will have a slow and steady climb up. We're pulling out onto a 1 hour chart on euro dollar. We've been playing around with this 50-day moving average. It was probably fortunate for the euro bears today that such a strong technical area was in place. It was the swing point at 43.75 that's given to clients each day. It was the 50-day moving average as well, which was also the low of the European and US session in the previous trade. So from a trade perspective, 60% of the dollar index is wrapped up in euro dollar, with euro dollar holding above that 50-day moving average. This wasn't buying euros to celebrate the rescue packages or buying euros because of the condition of the European outlook. This was all about buying euros because equities were moving higher. Equities moving higher, risk is getting bought, dollar tends to get sold as bonds get sold. When we get that reaction in the S&P, and it was a strong drop in S&P today, euro did not pick that up. So we are looking for a lot more weakness out of euro dollar. And if we go sub 43, 143 on euro, we are looking for 41.50 and then 40.50 on the downside. The pound did react. The pound reacted a bit quicker than euro did and got to the 50-day moving average. Now that's going to be a very strong area. Do not sell the pound in this Asian and early European session at this point in time against the US dollar, because this is very likely to bounce. Technically, we've got a three-wave structure, an ABC down that's formed. That has completed on this 1 hour chart. So you would expect the Great British Pound to find buyers in the overnight session just as a relief rally to then sell from. So if you are bearish on pound against the dollar, just wait for this pullback higher and sell it from a higher level. Clients received this signal on the Aussie dollar today. We were looking at a very strong move potentially that the S&P market started to form. Unfortunately, it took Aussie dollar just a little bit longer than may have been expected, but once it did break, the signal came out to clients short from 710, 710. Once that did break, it took 100 pips straight off the bat on Aussie dollar. A very good clear-cut signal. That has completed, running into the 50-day. As support, you'd now be looking to buy Aussie dollar if you're a bull at this level for a little bounce, but just near term. If you're going to look to sell it, don't sell it ahead of this 50-day moving average break. You need to sell it maybe from a retest of this 680 area. Got retail sales and the trade balance numbers out of Australia this evening as well, so we're going to be all over this currency pair, awaiting reaction to the 9:30 East Coast time this evening for the movement in Aussie dollar. Dollar yen and dollar Swiss, if we pull dollar Swiss over as well, both look very, very similar. Susceptible to dollar weakness, Both of them are interest rate linked. You've got to be very, very careful trading both of those pairs in the current environment ahead of the non-farm payroll.